There are reasons to believe the US and European economies might avoid the worst, even though rumblings about a potential recession are becoming louder. Are global recession to begin in Europe? If so, how will the recession impact the UK? What might cause a full-blown global recession? And what effects would a recession have on the nation? Stay tuned, as we will answer all these in this video. How will the recession impact the UK? The Bank of England cautions that inflation will reach 13% by year's end as the UK is headed toward a recession. Since the global financial crisis, the UK is anticipated to experience the longest recession. Interest rates were hiked by the bank yesterday by 50 basis points to 1.75%, marking the single largest increase since 1995 and the sixth straight increase. The latest gas price increases have caused another considerable deterioration in the outlook for activity in the UK and Europe, according to the Bank of England's Monetary Policy Summary for August. It also noted that GDP growth is slowing globally. As inflation increases above 13%, the UK is predicted to enter a recession in the last few months of the year. According to the research, household post-tax income will drop significantly in 2022 and 2023 as consumption growth reverses. Inflation becoming ingrained and not declining as we would normally anticipate is the underlying threat to which it is reacting. Household earnings in the UK are expected to be squeezed in real terms more severely in the next years than at any other point since the Second World War. If natural gas costs continue to rise in the upcoming months, UK inflation might reach 22% next year, Goldman Sachs Group Incorporated said. With hopes fading that inflation will peak in October, the projection is the most shocking one yet regarding the depth of the crisis playing out in the UK. Even more bleak than Citigroup's forecast from last week, which peaked at 18.6% in price hikes. Considerably beyond the 13% level the Bank of England predicted earlier this month is Goldman's outlook. The UK will be compelled to raise its energy cap by a further 80% in January, according to a note published on August 29 by Goldman analysts led by Stenjari Stan after a spike in gas prices. As a result, the inflation rate would increase to 22.4% and the gross domestic product would decrease by 3.4%. The bank's commodities specialists forecast that even if energy prices decline, the peak inflation rate will still be 14.8% in January. That would still be sufficient to cause a recession in the UK. Gas prices fell dramatically on August 30 as a result of indications that the region is stepping up efforts to reduce usage and stockpile supplies for winter, a sign of the high volatility in power markets. In recent days, prices have been incredibly volatile due to light trade and worries over Russian imports. Even so, the crisis facing Britain's future prime leader, who will be announced in the coming weeks, is brought home by Goldman's call. Both of the candidates competing to succeed Boris Johnson, Liz Truss, and Rishi Sunak have pledged to move quickly to ease the suffering of individuals and companies. Goldman anticipates that Truss, the front-runner, will provide further financial support of £30 billion. Inflation reaching its peak later and higher would also suggest that the BOE may need to raise interest rates more quickly. Currently, investors predict that the key rate of the BOE will increase to 4.25% from its present level of 1.75% next year. What might cause a full-blown global recession? The current financial crisis that the UK is currently experiencing is the result of numerous elements at play. They are significant obstacles on their own, but not a crisis. But the UK's repeated lockdowns, which are slowing the economy, together with the fall in gas and oil prices caused by Russia's invasion of Ukraine, raise the possibility that the unstable situation is about to deteriorate further. The data is consistent with warnings that the economy will experience sustained low growth due to a cost of the living problem that is only expected to worsen in the coming months as oil prices climb and inflation picks up steam. Companies have cut staff as a result of Russia's invasion of Ukraine, high inflation, and continued supply chain disruption, which has soured the trading environment and lowered the prospects for growth in the UK. The rise in energy costs brought on by Russia's gas import restrictions will make the decline in real household earnings in the UK worse. In response to a once-in-a-generation cost-of-living pinch, consumers are drastically cutting back on their purchases, according to George Lagarius, chief economist of the accounting company Mazars. The future signals are concerning for an economy where spending is so important. Although we may not technically be in a recession just yet, for many customers it undoubtedly seems that way. What effects would a recession have on the nation? A recession has real-world effects on everything from job chances and housing to investments. A recession is defined as a drop in the gross domestic product, GDP, for 2 consecutive quarters. Jobs may be lost as a result of businesses cutting costs during a recession, and wages may not be enough to meet the cost of basic necessities due to rising inflation and energy prices. The 2008 global financial crisis caused unemployment in the UK to approach 10%. It is challenging to describe the specific effects on UK employees because nobody can foresee the depth or duration of a recession. According to Forbes, lenders tighten conditions for mortgages, vehicle loans, and other sorts of lending during a recession as more people find themselves unable to pay their obligations. As a result, you might require a higher credit score or a bigger down payment to get approved for a loan than you would under more stable economic conditions. A recession can cause investments in assets like stocks, bonds, and real estate to lose value, reducing income and savings, and even depleting retirement funds, it was said. Recessions have a disproportionately negative impact on young people, as we witnessed with the recession of 2008. They also have an adverse effect on workers who are less trained and compensated. Recessions are sometimes viewed as an inevitable element of the economic cycle. They might trigger a clearing out, or what some economists refer to as a correction or reset. This might benefit certain people or industries indirectly. For instance, excessive inflation, like that seen in the early 1980s, typically results in higher interest rates, which is advantageous for those who have savings. Generation X and younger baby boomers were able to get on the housing ladder as a result of the recession that hit the early 1990s, which also resulted in lower house prices and mortgage rates. Where does the rest of the world stand? The possibility of a recession in the US and Europe has increased significantly. Chief economist at Berenberg bank Holger Schmieding told the newspaper that what was once a rising risk has now become the most likely scenario for an economic contraction in the US and Europe next year. According to the Financial Times, economists have grown more pessimistic about the likelihood of a recession as a result of the Federal Reserve's decision to raise interest rates in order to combat skyrocketing inflation and as worries about Europe's gas supply during the upcoming winter season grow. On 5 AUG, the International Energy Agency issued a warning, telling Europe to start making preparations for winter without Russian gas deliveries. Risks of a U.S. recession are uncomfortably high and increasing. The probabilities of a U.S. recession in the following year are 40% more or less, even over the following 24 months. Even worse off than that was Europe. The world economy needs some good fortune, a swift winding down of the effects of the Russian aggression and the coronavirus pandemic on the economy, as well as some shrewd management by the Fed and other central banks to avoid recession. How much time will it take? The most piercing of warning sirens have gone out, the bank declared. It's forecast that a recession may continue as long as the Great Financial Crisis and be as severe as the one in the early 1990s is a major shock. The recession is anticipated to extend the entire next year, with inflation scarcely falling below 10% even in a year, if global wholesale energy costs stay where they are today. This type of projection, which could in other circumstances have driven a rapid emergency budget, but could instead upset all the plans the candidates have stated during their campaigns, comes as the Tory leadership race is still in progress. The UK economy is anticipated to contract for more than a year, making it a textbook case of stagflation and a real full-fat recession. The content in this video is for entertainment purposes only and hence should not be considered financial advice. Do conduct your own due diligence and consult your financial advisor before making any investment decisions. With that, we have come to an end. See you in the next one.